Did it? What's up, everybody? We are back. Even I Can Trade. Today is January 31st, 2023. Another market day. We are in these trades. Today, I want to talk to you about growth because it's one of my favorite subjects. What do you do when you grow? When you are successful at this, when you get this nailed down, what does the future look like? Because I just feel like there's almost nobody really talking about that, or if they are talking about it, they don't come at it from the same perspective. So you've got channels out there that'll talk about how to make a lot of money quickly, and you have channels out there that'll talk about what to do once you have a lot of money, like invest for retirement, or if you don't want to work anymore, all that kind of stuff. But rarely do they connect the two. So I want to kind of try to connect and be that bridge between how do you start with nothing, and when you don't have nothing anymore, what do you do with it so you don't have nothing again, right? So in this video, first I'm going to talk about what I'm doing today. The market is a little bit more bullish than it was yesterday. So we've got kind of like a tepid rally going on. We're up 28 points. A lot of bullishness. Well, not bullishness, but it seems like the lows are getting bought up every time when the market wants to drop. Like, we rarely have two red bars together. Every time the market wants to pause, it seems like it gets bid up a little bit. So I'm in a call right now, and I got into this call pretty early. I said I wasn't going to get in before the announcement, but I did. So, that's just me. But got into this call. I'm sitting at 40.90 right now, which is, I think it's 60 points above where I bought it at. 55, and a pretty decent ways away from the market. We're already trending ahead to be profitable. So unless the market gets really finds its feet under it, right now we're trending to go ahead and beat the market, which I'm happy with. Pretty comfortable margin as of right now. And if we get any kind of stall in the market, like we're tapping our head up against R1 right now. So if we get any kind of stall in the market, that should really cement things. The trade is definitely in the green right now. Excuse me. And one thing I've noticed is if the market trends even a little bit below this line right here, the trade is usually in the green or profitable. And even better, if I take this particular line and I drop this down, say 20 points, and right here, and the market is trending below this line, we're absolutely profitable right now, where we could close out the trade at the moment for a profit. So just something, if you're tracking these trades the way that I am, this is one way to kind of tell if you're going to be in the green or not for your particular trade. If you're paying attention to like stuff like gamma and all that kind of stuff, your trade almost certainly will be in the green. If you pop this 20 points down and the market is trending at least 20 points down from where your strike is, your trade should be in the green pretty much any time that it's below this line. So just something else I noticed. Anyway, so what I really want to talk about is these larger trades, because of course I'm messing around with my spreadsheet and planning out, game planning. Okay, what if I can get this thing figured out, in the next couple months? What if we really start picking up some steam and I'm able to, keep my discipline and not take, too large losses and stuff like that? What happens when we really start picking up some steam in the train? What adjustments am I going to make? Because I am going to make some adjustments, because like I keep telling you guys, trading with larger contracts is different than trading with smaller contracts. Trading with larger accounts is different than trading with smaller accounts. You have more options, you have more possibilities, you have more danger, you have more stuff to protect. The thought process is different. It feels way different to hit the button on a $100,000 trade than it does a $100 trade. So what adjustments are we going to make along the way? So I started trying to game plan that out. The chief thing obviously is to take less risk. So what does less risk look like where we can still make some appreciable amounts of money? So when I'm down here in the couple $1,000 range, my goal is to make about 4% per day, which I think is pretty conservative. And I can achieve that two ways. I can achieve that by doing one side of the market and getting a little bit closer to a particular trade and getting 4% off of a put trade, or I can do 2% on a put trade and 2% on a call trade and do an iron condor. Get a little bit further away from the market that way, but you have danger on both sides. So you have to be a different kind of careful with that. So the market's usually trending one way or another. So if you do those iron condors, you're going to be in front of a potential freight train either way. So you have to be a little bit safer with those, get a little bit further away, or make whatever adjustment you're going to make so that you understand that the market's coming for you regardless. So at least with a put trade or a call trade, you have half of that danger. So if the market wants to run away from you, you can just take a nap. But if you're in a condor, you can't do that. So anyway, the account's on the lower side, this is what I'm kind of doing right now. I added a width column to the spreadsheet because one adjustment I'm going to make as I get up in contracts is I'm going to make adjustments to the width of my strikes to widen out the strikes so I can reduce the contract size, because trading with higher contracts sucks. So at least to me. So right now I'm doing 5 wide contracts, which is as small as I can get on the SPX. The only way you can get smaller is trading something like the IWM or the XSP or something like that, SPY, whatever. Then you can get 1 wide contracts, but I like 5. So I'm going to stick with that until we get to about 20 something contracts. I personally do not like trading more than 20 contracts. I think at that point, that's when you stop getting your contracts filled in like one pass. You start getting lots filled and stuff like that. I mean, you can get lots filled even if you're trading 2 contracts, but I mean, this is when it becomes pretty regular, I think at this point. So I want to start making some adjustments here. Also, I'm going to start taking out money, at least for right now, once I get to about this point as well. Once I get to, the 5-digit level and as far as the account size, we'll start taking out money and throw it into savings. This is more of a growth strategy for me, because if I was being a little bit more conservative, I would actually start taking money out when I get to about the $5,000 level and start saving and taking money out of the market then. But this is more growth oriented, so I can kind of front load some of that growth. So on the back end, I can start saving a little bit more heavily. So once I get to about 5 digits, somewhere around there, start taking out money and starting to widen out my contracts. And I'm only taking out 30% here, where normally I take out half. So a little bit more growth oriented. So it's a little bit more aggressive here. And once I hit, about 25 contracts, I start widening out my strikes again. So this, you can look at the widening of contracts in 2 ways. The obvious way, which is where I, do a 20 wide put or a 20 wide call. Or I could look at it as if I'm doing a 10 wide put and a 10 wide call. Those both mathematically would equal the same thing here, as far as the goals of this particular sheet. So either one would work here. So I'm going 20 wide here. And one thing that you can do is you can really just multiply this number by 100, and that's going to tell you the total collateral that you're going to need to trade this for each contract. That's another way to look at it, yet another way. And you can also see here, I'm actually dropping my savings rate a little bit. The reason is, in this particular plan, I'm trying to maintain a savings rate of about $200 and some odd per day, $300 a day, something like that, to have more money reinvested into the growth side so I can hurry up and grow. Right. So this is, like I said, is a more growth oriented plan. So I want my savings to be consistent so that I can have the overhead go back into the account and continue that ramping up that growth and compounding that growth. So we grow pretty rapidly. So you're going to start to see more and more changes to the width right here, because the more and more we grow, the more contracts it's going to take to maintain that growth. So here I widen it out even further to 40. And I just keep widening. So one thing you're going to obviously run into is, okay, how wide is too wide? So that's again why I was talking about you can either do like a 20 wide put or a 20 wide call, or cut it in half and do both. That's a tactic that you can use to keep your contracts down, because I can get this number, my daily profit, out of just the put side or the call side, or I can get half out of both. So keeping that in mind, that's going to help me keep my contract size down. So you get to a point, okay, what's too wide? So in my opinion, looking at the SPX, when I go to mock up trades and stuff like that from the SPX, I personally think once you get to about maybe 100 wide, that's about as far as you're going to be able to stretch that. You might be able to go a little bit further, but as far as counting on it each day, if I pull over the SPX here and look at the contracts, if we start looking at our single stuff here, see, that might even be too wide. So your zero stuff, your zero bid right here, I mean, we're halfway through the day right now. It's almost 1 o'clock. So maybe if you trade earlier, some of this stuff will still be alive, but your zero bid stuff, you're not going to really be able to trade. You're not going to be able to buy it or sell it or anything, right? You might be able to buy it, and your long leg is the stuff that you're buying, but it's going to be hard to adjust. If you need to close out the spread in totality or something like that, you can always close out the short side. But you know, once this stuff reaches zero bid, it's kind of tough to deal with. So anyway, if I look at, let's say we were going to do like a 4,000 put spread right now. So to mock this up, I would sell this, and then to get to 100, I'm already down to the 3900s, and 3955 or 3960 is as low as I can get with this current particular market. But if I look at tomorrow, it's probably going to be available, so that might be a better bellwether to what we can find in the morning. So if I look in the morning and I want to get this 4,000 right here, let me add some more strikes here. So if I want this 4,000 to do a 100 wide spread, I would need to get the 3,900, which is right here. So that's still alive, right? It's still alive. It may or may not be there tomorrow morning. I think it might be, but I think that's as far as you're going to be able to stretch these spreads realistically when it comes to the SPX. Now, one thing that you can do is you can walk over to the index, because they have much more delineation when it comes to your spread widths, because it's just it's like 4 times as big or whatever. Excuse me. So if I come over here, and I'm going to need to add more strikes, because just to try to be realistic, I want to try to keep the deltas somewhere similar. So let's add those strikes. If we look at our delta, let's say we were looking at like a 7 delta. I need even more strikes. Okay, do 200 there, whatever. All right, so if I want to look at like a 7 delta trade, which is right here, and this is 11,640, so I want 11,540, so that is right here. So you can see this is much more palatable to do that same 100 spread, the 100 deep spread, or wide spread I should say, on the NDX. So I can swap over. If I run out of SPX, I can come over here and start doing 100 wide spreads, maybe even wider, maybe even 200. I probably wouldn't push it to 200 personally. I probably might as well just go over to doing naked options at that point, which is what is in my plan. Is once I get to 100 wide, I'm going to swap over to doing naked contracts. So, but you can probably push it out if you want to, maybe even wider, but I'm going to stop at 100 wide when I get to that point. And again, what that allows me to do is keep my contract number down, so I don't have to run into the problem of trying to get like 1 million contracts filled, thousands and thousands of contracts. Now these indexes, a lot of times they have that inventory available for you to trade, but it doesn't come around as quickly as, you know, these smaller contract sizes. So if you go over here and you look at options time and sales, for example, I've got it filtered to only give us the contracts that have traded that are above a certain amount. So a minimum of 20 contracts per fill, I've got that filtered out on the NDX. So this is all day today for January 31st. This is today's trading only. These are all the contracts that have traded today that are above 20 contracts. The highest was 100 contracts, right? So once you get to that 20 level, things start thinning out as far as being able to fill you at one time. So there's not a ton of liquidity out there. Now, not to say that you can't get filled. Like if you put in like 1,000 contract order, I mean, you might get filled, but you're going to get filled in pieces. And that's time, because if you're not getting filled, the market could move away from you and just leave a piece of your order filled, and then the market is run away, right? So that's a consideration. That's why you want to consider your contract size, because if you're trying to fill like 1,000 contracts and the market's filling it at 1, then 5 minutes later another piece fills, and then 10 minutes later another piece fills, and then the whole market dynamic could have changed and ran away from you, and you're only left with like a piece of your plan filled just because you have so many contracts. So you have to be cognizant of that. But on the NDX is much more thinly traded than the SPX is. So if I come over here to the SPX, there's going to be a lot more inventory when it comes to these larger contract numbers. So if I fold this up, hope I didn't. Crap. Hold on. No. There we go. Let's let this fit. Let's let this load up here. Hopefully. All right, so let me try to close this up without clicking anything else. Go to time and sales. Let this load in here. All right, so it's a different story on the SPX. It's way different, right? Now, again, the SPX is a smaller trade. It's like 4 times smaller from a size standpoint. Like trading a naked put on the SPX is like 75,000, where on the NDX it's like $250,000. So that's a huge difference. So you're gonna get, you're gonna be able to do larger numbers just off of that on the option side on the SPX, but it's not going to be just a stream of orders coming through at that size. You're going to get a lot of bigger size that you're going to be able to handle here. But again, it starts to get unwieldy once you get above like the 50 contract level and stuff like that. They only, kind of trickle in every couple seconds or something like that. And that's seconds that the market could be running away from you while you're trying to get a fill. And again, if you're trading on Thinkorswim, what nobody is going to tell you, period, is that once you start trading above a certain contract size, and I forgot what the number is, I have to check with my friend who was doing those size contracts, but once you get above a certain amount of contracts, it flips over from automatic computer trading to a live person handling your trade on the exchange. And a live person is going to be slower than a computer. And this is a problem if the market's moving on you and you're trying to put in an order and then you need to cancel the order because the market is moved on you. Your order is going to be sitting there talking about some wait. Like it'll literally say under your fill status, it'll just be like wait, stop, or wait, or something like that, while the live person is wherever they are in Chicago getting to your order to cancel it. Like a person has to like hit the cancel button on their end after you hit your cancel button, and that's time taken away. And you're sitting there like, okay, I needed to cancel. For all you know, the order could have filled and they just haven't gotten back to reporting back that your order is filled yet. That's super annoying. You know what I'm saying? And it could cost you money, especially at those larger contracts. I don't know why they do that. I would be thinking it'd be the opposite, but whatever. That's something that you don't want to deal with. So I have to check my friend and see what that delineation is, what that magic number is. In my head, I keep thinking it's like either 50 or 100 contracts. I think it's 100 contracts or something. I don't know, something like that. At least 50. Below 50, I think you're below 50. I think you're safe, but higher than that, I'm not sure. Anyway, you want to keep your contract small to keep all that mess out of your flow, because that's the stuff that nobody tells you, that you just have to experience unless you're listening to me. Anyway, so you can see right here, here's the order flow that's coming in. These are actual traded contracts that are coming in, and they don't come in, they kind of trickle in. But if I turn off this filter, let me see, turn this particular off, and these are only for the 0DTEs. If I turn this filter off, you can see it starts to roll in as fast as my computer can let it, right? It's coming in chunks, right? But you can see the max size. These are the largest traded ones for puts and calls. The largest ones for a call is 500, largest one for a put, 2,700. That's a lot. So like I said, it can handle it. It's just a matter of how fast is it going to do it, right? So yeah, I just wanted to show you that as well. So if I get back to our trade plan here, yeah, so 60 wide contracts right here. So I'm only doing 13 contracts, but I'm making $3,000 on these same contracts. So this is keeping my risk essentially the same as when I was trading with lower dollar amounts here, because I don't have all that junk to deal with the larger contract amounts. So the experience of trading is going to be similar, even though the dollar amount of trading is going to be less. Now, one thing to watch out for with these wider spreads is the profitability is going to be a little bit less than if I was doing tighter spreads. Tighter spreads are more profitable dollar for dollar than wider spreads are, but that's okay. I don't need it to be like the same, as long as it's within the same ballpark, right? I'm okay. But just something to be aware of. And also something to be aware of is, since you're trading these larger spreads, the option that you're purchasing is going to be way further out of the money than the option that you're selling. So that option that is way far out of the money is going to be hitting a zero bid way faster than if you're trading a tighter spread. So you could be in a situation where you need to close out, and because of theta decay, the decay has happened much faster on that long option than in your short option. It could be possible that you cannot close out or roll that spread should you need to, if it's something like later in the day where your short strike is being threatened but the long strike is not. You know, that could become an issue too. So where you just have to close out the long leg or something like that. So you need to leave some money on the side to compensate for that particular issue. You can also, if you need to, you can roll the short strike away from the market without messing with your long strike. That's something else that you can do, but it's something that you need to be aware of, because you don't have that problem when you're trading tighter strikes. So you need to be cognizant of that situation when you're trading these wider spreads. But anyway, so, and that's another reason why I said, like, once I get to a 100 spread, I'm kind of just done with spreads at that point. I might be done with it faster than that, but this is just according to this particular plan. If I run into a situation where this gets unwieldy, then I'll have to shift. This is just me thinking right now. So, you know, here's my 100 spread situation right here. Here I am actually lowering my daily profit to 3%. And again, that is to kind of compensate for the wider spread. I know this is going to be a little bit less profitable, so I don't want to plan for more or the similar profitability in these trades when I'm doing with higher spreads, you know, because I know it's not going to be the case. So I account for that by lowering the profitability right here, but we're still growing. And I get to a point where it's like, okay, I'm getting, you know, I'm getting up to the point where I'm still getting higher spreads. No matter how much I widen out the spreads, I'm still getting to the point where I'm trading a lot of different contracts. So when I put in this number right here, a 750 wide spread, what that is really saying is this is a naked contract. And the reason is, if you remember what I said earlier, you multiply this number by 100 and you're going to get the collateral that you need to trade that particular spread. Well, remember, SPX takes about $75,000 to do a naked put on margin. So here I'm basically saying I'm going to spend $75,000 per contract to trade at this particular level. Now, I'm probably going to move this higher up, you know, to get to that point. But, you know, this is just where it is on the spreadsheet right now, because I wanted to start trading nakeds at about a year. So what I'm saying right here is this is basically a naked SPX trade. Okay. And I've got in here in this little note, SPX naked equals about $750 and NDX naked equals about $2,500 per this sheet. Okay, so if you enter those numbers in there, that'll give you the value of contracts that you need to make whatever with the naked contracts. All right, and then what I also did to pair this is the profitability is really going to be much lower once I start doing naked stuff. So if I'm doing naked stuff, then I'm aiming for about 0.4% per day. Because when I go and mock up the trade, I'm comfortable with this profitability compared to where the delta is for earning this particular amount for that trade. So I really lower down the profitability here, and you can make your own call in there and mock that up. And I'll even show you, for example, if I go to the SPX and go back to this right here, I'm already on singles. So if I go to say 0DTE, I can go to my return on capital column and make it really easy and find, let me shrink this back down. All right, so I could just go to our rock column, 0.04% is, no, I'm sorry, I'm looking for 0.4%. So this is actually 0.4% right here. This is too close for right now. I could achieve this with an iron condor too. So I could do 0.2% and then do a condor on it. But today is already kind of baked in because it's too far in the day. So let's look at tomorrow to be a little bit more realistic. So if I wanted to do just a put, a 0.4% profitability put would be $39.60. So I sell this and I'm just going to do one. It's going to be a naked put. And then I look at our confirm and send, and it's about $77,000 to get a 0.4 return on this particular contract. So that's only this number right here. That's only one. And you can see, I think per the sheet, we were doing what, like 18? Let's see. So yeah, so 18 contracts on the SPX, which is about 75,000 ish. And I'll do 18 contracts. We should get around the number that profitability that we were looking at there. So 18 contracts and risking about 1.3 million. And we are making $5,700. Let's check that, see how close we are. And we're in the ballpark. See that? 1.3 million needed, about $5,300 expected. That's what we find right here. 1.3 needed, $5,700 expected. So we're definitely within the ballpark. So these are realistic numbers. This is how you get those realistic numbers once you get into the big boy numbers, right? And the 7 figures and stuff. So 18 contracts, we continue to grow. And, you know, we get up into, now it's easier to do naked contracts at larger contract numbers. So I can let this go a little bit more if I want to. But I probably won't let it go too far. But you can see for me, once I get up into this level right here, about 50 contracts, then I swap to the NDX. And at this point, we're at like $3 million, $4 million account level, right? Once we get up to that level, I switch over to the NDX. And again, these are like $250,000 contracts, right? So 2,500, 15 contracts at that should yield this particular amount. We can go back and check if you want. So let's go to the NDX, do kind of like the same thing. We're going to check the big boy numbers here. Let this load up. Delete this trade because we don't need it anymore. And we're going to look at our return on capital column. Actually, I'm going to go to today's trade just because it's probably going to be closer to where we're at. So if I want 0.4% here, that's going to be about this one right here. Same thing, one contract naked put. What does that give us? So this is about 235,000 needed to make $840. So how many contracts were we at? We were at 15. That 15 contracts should give us about $14,000 in profit that day, 3.7 mil. So let's bump this up to 15. Confirm and send. All right, so our max profit 11.7, need about 3.5. Are we close? Right here. All right, so 14.9 and 3.7 needed, so we're pretty close. So we can finagle that. So this is giving us 0.36% return. So I'd have to bump this up a little bit by one contract to get us the return that we're looking for, and make sure that that meets our risk goals and everything like that. But if I pop this back in there, do 15 contracts of this one, 15.6 against 3.5. Yep. So we're above target with that particular one right there, 3.5 instead of 3.7. So the math works even at these very large numbers, right? And, you know, I don't know if I'm going to continue, right? At this one, I just said we're just going to take out 50% into our savings and everything and grow like that. I don't know what I'm actually going to do once I get here, but this is just for planning purposes. But you can see, regardless of how big you want to get, my contracts are still in the 20s, you know, and I can go like this probably till, I don't know, 10, $20 million, maybe even $30 million in the market, and realistically actually trade. It'll be tougher to get these fills. But again, naked contracts are easier to fill than spreads because you're dealing with half as much. But I can go to, you know, a significant $1 million level and extract from the market daily a good number out of the market. And if I want to, I can drop this daily profit number down. So like, let's say something realistic. Let's say I've got all this money in my account that I've built up and I want to trade the NDX. And I could do, say, 10 contracts on the NDX today, and it's like 1 o'clock right now, and I want to get a put that I can just relax and not even worry about, right? So I could sit here and sell this particular put, do 10 contracts here. You can see how far away from the market we are. The NDX is at 12,000. I want to get an 11.9 put. That's at like a delta 0.004, not 0.4, but 0.04 away from the market. Market is in absolutely no danger of touching this whatsoever. This is like a take a nap trade. I can do 10 of these and I can get $1,000 today off of an absolute sleeper trade that I don't even have to watch. And that's below my number, you know, at 3 point whatever million. I'm only using 2 point whatever million to make $1,000 that day. You know, and I can just go take a vacation, you know, or whatever once I get to this point, right? This is sleeper money. You know what I'm saying? You do this every day times 250, that's $250,000 right there. That's, I mean, come on. that's I mean, I don't even know what to say, right? Like once you get to these $1 million numbers, if you really know options, I mean, life is your oyster at that point. I can make this trade and just go away and not even think about the market right now, right? So, and you can get almost as conservative as you want to. This is it 4 hours left in the market and I could put in this trade and not even think about it. Or I could do something down here. And if I just want to make something, if I want to beat my bank interest that day, I can come down here and be even further away. You know, they've got trades all the way down to the 870s. They have a bid on it. You know, I could probably get somewhere in the mid on something like this. Or if I want a tighter spread, I could just jump back to the SPX and do the same stuff. You know, if I want a tighter bid, if I want to, because sometimes these wide bid ask spreads, you're not sure what you're going to get. You're going to get a lot of slippage. Slippage being, you know, having to get closer to the bid than to the median between the bid and the ask to get filled. But, you know, if I want to come and do this SPX trade, you know, I can do whatever down here, not even have to worry about anything if I don't want to, right? You know, I can come down here. The market is at 450. Is it going to drop 30 points in 4 hours? Probably not. And if I am even worried about that, let's say I'm worried about that. Let's say I'm worried about the market coming down here and taking out my put that I'm trying to put on autopilot. Okay, well, I could just switch to the SPY or Apple or Amazon or whatever your favorite ETF is, that's liquid. And you can get that list on, you know, just do a little Google search like I did earlier, looking for a liquid particular position. SPY is going to be the most. It trades like 8.2 million contracts a day. So you got plenty of contracts out there for you. Or I can go to Tesla or Apple or Qs or whatever, and I could go in here and, you know, just fill her up, man, and go as far out as the market's going to let me. You know, right now the market's going to let me get, you know, to 398 or something, 399. Right now, 4,000 is a major support level. So I could just go down below the support level for the week and then do a daily trade with 4 hours left on it, like this one, and put as many contracts as I want to on it and just let it go. You know what I'm saying? So, and if it does take me out, so I almost forgot what I was about to say. If it does take out my trade, let's say the market does dip now for whatever reason, takes out my trade, then I just get assigned. And I haven't lost the $2 million or whatever. It just flows into a cheap price for the SPY or whatever I'm trading. You know what I'm saying? And then I can sell cover calls on it and roll right into the wheel strategy. So it's just crazy, the opportunities and the options that you have once you start getting up there into these larger dollar amounts. So once you know this stuff, this is like a life skill, man. Like this is something that, like, once you cross a certain threshold, you don't, I mean, you're just done, right? And heck, you could be making so much money that you could just turn yourself into like a small prop trading firm and then pay a young guy to do the trades for you. You know, once you have enough money, you could just pay somebody $50,000 a year, do the trades for you, and split the profits, you know, 80-20 or something like that, and let them trade for you, and you don't have to touch it. You know what I'm saying? Or whatever, you know what I'm saying? So you got options, all I'm saying, once you get up there. But I like to think about the bridge between, okay, you started with this. How do you make that transition to the next level? How do you make that transition to the level after that? Level 2, level 3, what does that transition look like? What do you do from there? And that's really why I really like this sheet, because it takes you through the entire transition process. And then you can further transition from here. Once you build the savings side up, you can go buy some real estate. And the reason real estate is such a powerful tool is because of leverage, which is also why options are such a powerful tool, because it has similar leverage characteristics to real estate. Real estate, generally you put a certain amount down, you put 20% down, 10% down, whatever it is, and then you get to buy a property that's 8 or 9 times larger than the money that you could raise. In options, it has a built-in 100-to-1 leverage, because all the options are levered 100 by 100, because each contract you're controlling 100 shares. So you have a massive amount of leverage, which is what makes options so dangerous, I guess. I'm just gonna go ahead and call them dangerous, or potent. Maybe potent is a better word. That's what makes options so potent if you know how to use them, because they have that built-in leverage built right into them, just like real estate does. That's why you got all these real estate millionaires out there because they were able to leverage up all this money on a growing asset. You can do the same thing with options, but even higher leverage if you know how to wield that leverage and control that leverage. Okay, so I'm gonna stop preaching. I just love this sheet. I love thinking about the future. I love thinking about transition and how to get from one step to the next step, all that kind of stuff. And this tool really illustrates that beautifully.